I'm curious if you can kind of highlight maybe some of those common mistakes, and maybe mistakes isn't the proper word if producers just aren't aware of what options are out there when it comes to end of year book work and preparing for tax season. So would you mind, picking one for now and talking about that?
Just picking like some overall like tactical strategies to help them kind of no matter what they choose.
Well, I know previously when we chatted, Hannah, you've talked about, so for example, like making sure the accountant has a full breakdown of loans, reviewing depreciation schedules.
Yes.
We've talked about effective tax rate versus marginal tax rate. I know you're passionate about understanding Schedule F versus Schedule J, if I'm correct. So maybe let's dive into some of that.
Yeah, yeah. I mean, these are good tactical strategies no matter the size of your operation, right? Like when you're dealing with accounting and ag accounting, you see a gamut of the people that prepare those, right? You will have like shops that are more old school where the farmer rancher just mails their bank statements. This is crazy to me. They mail their bank statements to the accountant. The accountant has staff, right? Um, that they pay, 20 bucks an hour and then they charge the client 3 to 4x to prep that. And so it's all good and well, but I think that that can kind of be conducive to the farmer or rancher kind of putting the head in the sand as far as like their financials, right? And it's also doesn't really let them have a sense of like what's working, what's not. But it also, there's some details that can get lost, right? Like, so hypothetically, let's say someone goes out and buys a tractor, and instead of running it through their bank, they just get to Ag Direct, right? It's a loan. They won't make their first payment for a whole nother year. So then we get to tax prep. And it's often clients come to my office just because they're frustrated with their prior accountant and they're like, I told them I bought a tractor. And I'm like, well, give them the benefit of the doubt, this is not on your financial records, right? You haven't made a payment yet. You bought a tractor. The journal entries weren't made, debit equipment, which is, assets go up with debits, down with credits, which a lot of people like, I don't expect clients to ever know that, right? But when I do like have this conversation, like no one put the asset on the books and no one put the liability on the books. So the books don't know that this tractor ever existed. You know what I mean? So I think a huge thing with helping anyone prep for tax season is as they get those purchase orders throughout the year, either send them to the accountant, upload them to the portal, just keep them in a tax file. I like with my clients, I recommend a folder system, right? So as their tax documents come, they just put them in a folder and then upload them at one time or drop them by our office. We have a like physical location, and so sometimes that's helpful for them to just like drop off their packet. We have a quick little questionnaire in there for them, a checklist of like, here's all the source stocks you brought us last year. We're going to need these this year, or a reason why they're not in there. Anyway, so that'd be a good time to just like start that next year's folder and put all the purchase orders in there, right? We also talked about loan balances, right? When you're tying out your balance sheet, putting in there the loan balances at year end. Oftentimes, people make payments, but they're missing the interest expense. They're just taking it against a loan on their books when they could be missing out on, tens of thousands, hundreds of thousands of interest deduction that aren't on their books, and so I think really making sure all interest is accounted for, whether it's with your bank, Ag Direct. I have a couple clients that got like SBA loans and they don't send those out in the mail, those interest forms. You have to like log into your portal and print it. So unless you're really like deep diving with clients, like, let's tie out this balance sheet. Tell me about every single loan you have. It's a lot of work, but in the long run, like the juice is so worth the squeeze. So we talked about that, all interest balances. And then my favorite thing is effective tax rate and marginal tax rate, right? Just because you get clients that don't understand their effective tax rate, which your effective tax rate is essentially the average tax you're paying on every dollar, where marginal tax rate is for every extra dollar you take in, what will that be taxed at, right? So people could have like a 22% marginal tax rate, but their effective is only like 14%. And so I think that's like the biggest thing people don't understand. One is their effective tax rate, which factors into something that's factored into it is qualified business income deduction. This came out in the Tax Cut and Jobs Act. It just was extended again with the OBBBA, OBA, whatever we want to call it. And so it's essentially a 20% tax deduction for taking in income. And there's certain thresholds, right? You cross 400, 450, like this is inflation adjusted. So depending on when they're listening to that, that threshold will change. But up to that amount, as long as they're not a specified service business, accountants, unfortunately. But farmers and ranchers definitely aren't a specified service business. They get a 20% tax deduction just for taking in income. And that can be really profound. I mean, that's essentially like buying something that you didn't buy, right? You have 100,000 of taxable income. You get a $20,000 deduction. That's that's incredible. And so I think now is a great time. And this OB3A that came out, we also kept tax rates lower, right? They were expected to go up. We kept them low. And so I think when people understand their effective tax rate and like how it breaks down, I think they're not so fast to think, oh, I need to prepay so much. Oh, I need to go buy more green or red paint. You know what I mean? I really hate to see when people try and like buy their way out of tax just because it really hurts them on the working capital perspective, but also like on the equity perspective, right? And it's kind of like a vicious cycle, right? You buy equipment thinking you're outrunning tax, or you have this mindset that your goal is to pay zero tax. And that actually really hurts your operation. When a lot of times these clients, we get them in the door, they think they have these like huge prepaids they want to make before year end, or um, some just keep the cold cow check on the fridge till after year end, whatever. And then we can really get down into it and say, okay, this is your effective tax rate. And you hinted at Schedule J. So Schedule J is the form we use to income average. And so essentially, you income average on the prior three tax returns. So let's say we have low, low, low years, we have a high year, we can fill up those prior year tax brackets, which is like so cool. Like we can't do that as accountants, right? Like no other industry can do that. And so you have to be careful what counts as like farm income, but I mean, selling coal cows, selling commodities, you know what I mean? Like most of the time it counts. Your accountant will sift through what does and what doesn't. All that to be said, there's often times where we could take in like a big coal cow check or sold equipment or, whatever's in the rotation and income average back. And we're effectively paying like 7% on that money. And you took in, 300,000, 200,000. Like you'd be surprised how much we can income average back and they're like, so you mean I don't have to cut that check and ratchet up my line of credit? And I'm like, at the end of the day, this is your decision, but writing off this 100,000 saves you $7,000 in tax. To me, that's not a good deal. You know what I mean? And so, yeah, I just think it's like people just really have to work with their accountant, know their effective tax rate, know their marginal tax rate, have honest conversations like, where am I comfortable paying tax? You know what I mean? A lot of clients, when I ask them, where's your tax palette? What are you comfortable with? I have some that think 24% is the greatest win, right? I have others that are like, I think 12 is good, right? The government gets 12 cents. I get to keep 88 cents, like working in my operation. That seems reasonable. You know what I mean? And also with that income averaging, we can structure it on a multi-year level where instead of paying ordinary income and self-employment tax, which is essentially like 15-ish% on top of your ordinary income rates, we just choose to, kind of level out that Schedule F, keep it at zero, keep it at 400 bucks, if we really want to play it close. And then we'll have 97, so selling coal cows, selling things like that. So that can be the income that we take in and we just kind of defer a bit. But then in that fourth year, we just spike the self-employment income and take a big Schedule F. Then you're filling up that Social Security Medicare cap once instead of paying like 15% on 100,000, 100,000, 100,000, and then, whatever it is at that year, because again, inflation adjusted, they just came out with the 2026 ones. So there's just so many strategies to use that I think are underutilized, and the IRS themselves have said that Schedule J is underutilized, but IRS isn't going to send you a letter saying, "Hey, you could have income averaged, try again. We put a Schedule J in there for you, so, now you're getting this check back." And honestly, not a lot of tax softwares are good at catching it.